to the Possible Promise podcast. Every Monday and Friday, we go live at 12 p.m. Eastern to break down the complexities of finance and point the way to financial freedom. Today is June 8th, 2020, and I am your host, Brandon Oliveris.
And I'm his wife, Christine.
This is episode 1, Stocks versus Options. Welcome everyone, I'm so glad you could join us today. I have no idea if anyone is actually here or not yet, but we're going to pretend that they are.
There you go.
So this is our first, not really first, yesterday was episode 0, but our first live stream. I am really excited. Is this on? Yeah, it is. I'm really excited for this, a little bit nervous. I was kind of preparing all morning just so I knew what was going to happen today. But basically today we're going to talk a bit about what the market's doing, and I have a few stocks that I want to talk about specifically, and then we're going to go into our topic, which is stocks versus options. So feel free, if you are listening to this live, to go ahead and chat anytime. I will do my best to look at the chat. It should make a sound if someone chats. And I will respond either in the chat or out loud. We'll just have to see what happens. But feel free to ask questions, make comments, whatever you want to do. And I think that'll be fun.
Yes, it will be a lot of fun.
Oh, sorry. I did interrupt you.
You didn't interrupt me. I interrupted you, I think.
Yeah. See, it's your fault. So, today, actually, I'm going to see where the market is. Yesterday, I talked about how being a programmer comes in handy. And this is kind of Exhibit A, so to speak, because I was thinking, I want to talk about what, the S&P and the Dow and the NASDAQ are doing, and I don't want to have to look up 3 different symbols. It's going to take me forever to look those up. So what am I going to do? I'll write a quick little script in 15 minutes, and it'll tell me. So this little script tells me that we are up. The S&P is up about 16 points today. Only about 0.52%. The Dow is up actually the most of everyone, 272 points at the moment, over a little bit over 1%, and the NASDAQ is down about 7 points. It was down a lot more earlier, 0.07%. So that's where we are right now. It was a lot worse for the NASDAQ earlier. I think at one point I saw it down about 0.6%. Yeah, I don't know. There's this divergence. It's not normal, and Christine, you probably wouldn't know this, but
of course I wouldn't.
Usually you have the S&P, the Dow Jones Index, and the NASDAQ are all sort of, they measure different parts of the market, but they're all sort of together, mostly, usually. If one's positive, usually all 3 are positive. I mean, one might be ahead of the others, but usually, they go together, right? Well, for a while there, the NASDAQ was beating out the others. The NASDAQ is the technology index.
Right.
I don't know if you knew that.
You told me once, probably.
Yeah, well, so that's the technology index. And because technology has been such a big part of this whole thing with, the coronavirus and the new economy we've been experiencing, that's been ahead of the others. It was for a while. And then lately, because the economy is reopening and you have businesses coming back on board, so the S&P and especially the Dow has really pulled ahead of the NASDAQ. The NASDAQ's been super weak over the past, week or two, maybe. So that's been interesting. So it's actually down today. It was almost flat. When I checked about a half an hour ago, it was almost flat. Now it's down a bit more. Not a whole ton, but it's down. It's obviously week, the Dow was the strongest, up about 1%. So it's interesting. Just, there's this divergence in the market because of, what people are prioritizing, where money is flowing into, and that kind of stuff. The last week was nuts. It was just, the market was up. I don't even know what the percent was actually. I was going to look it up and I forgot to look it up. But it was just crazy last week, the whole market. And I mean, in April we had a 12% gain. In May we had like a 4% gain, and then now last week was the first week of June, and it was just blew up, especially Thursday and Friday, I think were the biggest days. And it was just nuts. And it was because on Friday, I think was the biggest catalyst, the monthly jobs report came out. And that's, obviously a report that comes out every month about how the jobs were the previous month. So, how are we doing here? So, on Friday, they reported unemployment rate 13.3%. They were expecting 19.1%. So, it was a huge, unexpected drop in unemployment, which is obviously a good thing. But for me, it's still 13%. It's not great. It's still 13%. We were at 3.5% before this whole thing hit. So, I mean, I personally don't think it's nearly as good as people think it is, but I don't know.
It's better than it was.
It's better. Well, no, that was the expected. No? It is better than it was. It was in April. I think it was 14 point something, 0.7, or I don't know. So it did improve a bit last month, so that's good. But it's still really horrible. I mean, this is as bad as it's been almost since the Great Depression, I think.
Oh, wow.
So it's been bad. Now, the one piece of good news is, that was the one thing. The other thing is that 2.5 million jobs were created last month versus the expected drop or loss of 7.5 million jobs. So that was really good news. That was extremely good news. And that's why this whole thing's been just taking off. Today's actually been pretty calm overall. I mean, besides the Dow up 1%, but everything else, it's a pretty calm day compared to Friday. It was up 2% Friday, I think, 2 or 3%. So it's been pretty calm today overall. It was tough because Friday I sold out at a whole bunch of my positions. I was holding on for a while, just absolutely positive the market was going to have to correct itself any day now, right? Because we had this whole run up to 3,000 for the S&P, right? Now the S&P, what was I saying? Now it's at 3,200. So this is, now I'm going to check again. Yeah, around the same thing. So 3,200 or so. But there was a whole big run up to 3,000, and it was hitting a lot of resistance. And all the analysts I followed were saying, that's kind of the line in the sand. It's not every time it approaches that line, it gets sold off, right? And it was. And just all of a sudden, it just crossed. It took a couple days. It kept trying to cross the 3,000 mark, and finally it crossed it, and it just took off from there. And the thing is, this is almost towards the highs we were at before the whole coronavirus hit. I think the NASDAQ hit a new high last week. So that's, for me, I think it's way too optimistic, because there's still, what did I hear I don't remember where I heard this, but someone said basically if you set up a portfolio 6 months ago and then kind of just, let's say you just were in a coma for the last 6 months and you woke up and looked again, you wouldn't know. Nothing would really have changed, and you wouldn't know that just by looking that we had 13% unemployment, that, businesses are still struggling, that, the economy is still under a lot of pressure. It's just the fact that we're at the same level we were at the end of 2019.
That's interesting.
Yeah.
I never would have thought of it like that.
Right. And that's the thing. I feel like they're pricing in a huge, a lot of optimism, And I don't know how much of that is warranted. I really, really think what I was saying is, like, I had to change my assumption on Friday. I sold out a lot of my stuff. I'm still kind of mid to long term bearish, because I think there's too much that hasn't been accounted for.
Right.
And short term, though, I think it's just too much momentum.
Yeah,
I mean, it's just going nuts. It's just it reminds me of February. Like in February, day after day after day, the market was going up and up and up and up and up, and everyone, people were warning it's going to correct any day now, and other people were saying, oh no, this is a bull market, it's it's going to go on forever, and then it collapsed. But it just reminds me of those days, because it's like it just every day up and up and up and up and up. That's not normal. So it really reminds me of that. I think there's a lot of momentum right now. I was thinking, like, where are we going to be at the end of the week? No idea. I mean, we could be higher. I feel like there's a lot of resistance at this point. I mean, just kind of intuitively what I feel. But I mean, who knows? Like, we could be up at 3,300 for all I know. Like, you just don't know. Or it could drop down. Sellers could finally step in. I mean, who knows? It's just, this is one of those points where you just don't know what's going to happen. I'm very hesitant to short the market because it's just there's too much momentum behind it. But I think that it's inevitable that in time, and that time could be weeks, that time could be a month or two, I don't know.
Stupid question. What is short the market?
Short the market. I thought, because it's shorting stocks.
A little bit. But...
Short the market just means you're bearish. It means that you trade in a way that you benefit by the market going down. Right? Okay. So, like, I think I would love to do that because I believe it will go down, but, like, there's too much momentum right now where there's an expression in investing, the trend is your friend, right?
I like that.
It's going up. Like, you don't go against the trend. Like, when you see that trend is starting to turn, then jump on it, and I will. But it's like right now, it's just too much,
Right. That makes sense.
So, yeah, that to me is how I see it. I'm definitely mid to long-term bearish, like, probably for the rest of this year.
But who knows?
I remember thinking, who knows? I remember thinking, like, back in, it was March, I think it was, when all these, the unemployment was starting to rise. And people were saying, oh, yeah, after all this is over, people will just go back to work. And it's like, you can't just erase a 13 or 15% unemployment. You just can't, like, erase that. Oh, it's gone. Like, I know a lot of people will go back to work, and so it'll definitely lower. But I can't see it going back to, like, 3.5% like it was before, or even anything near that 5%. Like, I just can't imagine going anywhere near that in the near future. So that has to be priced in somewhere. I don't know. But in the short term, I think it's just way too much momentum to be trying to short it right now. So it's just kind of riding the wave day by day. Like,
it's like surfing.
Sure, yeah, let's call it that. It's like surfing. But I'm going to see if we have any chats real quick. Oops, I'm in the wrong. It would help to be in the right window. No, okay. Let me check the other window. So yeah, that's my view on everything. It was funny. I was telling Christine about this morning. So one of the stocks I follow is Gilead. And that's, the company that came up with that. I'm not going to try to pronounce the drug because it's like, remember what I'm talking about? The one that's supposed to treat the coronavirus. I'm not even trying to pronounce it.
I don't know how to pronounce it.
Yeah. Anyway, but there was a rumor over the weekend of AstraZeneca wanting to merge with Gilead. And so this morning, now I did hear yesterday that was no longer true. They were supposedly having talks, and that was no longer true. But this morning, pre-market, Gilead was up like over 2%, And then it came out this morning from CNBC. Oh no, that's actually, it's verified that that's not true anymore. Whether it was ever true, who knows? But now, let's see where it's at. It was at it dropped almost all the way down earlier, so let's see where it is now. Yeah, it's literally up 0.32%, 24 cents. Earlier it was up a bit more, so it's been dropping all day. It opened up around $79. Now it's under 77. So it was just funny because it was yay, there's this wonderful things happening, and then it's never mind. Oh. Okay, so I'm going to get into our stock picks, but I just wanted to talk about that a little bit. I thought that was funny. It was just I could see what people were thinking. Yes, it's going great. This company's really succeeding. And then, so it was just funny. All right, so we have a special sound effect for this. It is time for our weekly stock picks. So I was okay, which stock am I going to recommend this week? Because there are a lot of them. Like I said, I'm hesitating to really go long on much of anything or short on much of anything. There's definitely a lot of stuff that's been growing a lot, but because of kind of where I think we are, where I'm very neutral or wanting to be bearish but not able to, it's hard to recommend a lot of stocks. But I did find something that I was looking at this morning. So I have a stock recommendation. Now this is something I have not, I'm going to buy this, but I haven't yet. So just a disclaimer, I don't have a position in this yet. But I will later. And so I'm going to give a stock recommendation, and then I'm also going to give an earnings play, a stock that's having earnings soon, because that can be really helpful. So we're kind of experimenting here. Okay, I'm not really sure how this is going to work long term, but I thought that'd be fun. So the stock I am picking today is Big Lots.
Oh.
Yeah.
I like Big Lots.
I know.
They have really good deals on K-Cups.
So you have Christine's vote of approval. And the ticker on that is BIG, B-I-G. Which I think is funny. So let me get down to my notes on that. So Big Lots right now is trading at, sorry for the voiceover, Christine.
I don't care.
Trading at $34.83. So they've been going pretty crazy so far. In fact, it's up almost 27% this year. Now there are a lot of stocks that are down this year. The S&P is down this year. Big Lots is up almost 27% this year.
Huh. Probably because everyone's going there.
Right. Well, yeah, I mean, pretty much. That's, and especially with retail opening up how it is, it's becoming really popular. So you would think, it rising 27% this year, it's probably really expensive. But it actually has a price to earnings of 8.2. Wait, wrong. Okay. Yeah, 8.2. And its price to sales is 0.26. So that's really cheap. So for Christine or anyone else who doesn't know, price to earnings is basically how much each share costs over what the company's earnings are. Okay. So, and then price to sales is the price into how much they actually sell. So price to earnings is good, usually below 15, below 20 or so. This is 8.2, so it's really cheap. Price to sales, anything below 1 is usually good. This is 0.26. It's a really cheap stock and valuation, right? So, when I'm looking at stocks, it just depends. I mean, there are different metrics you can go by. There's value, growth, momentum, income being like dividends and stuff. And when I'm looking at a stock, I'm more into the growth and momentum area, but I like to see good value if I can get it. So this one definitely has good value. Like I said, it's up 27% for the year. So that's definitely momentum there as much as you can want. So let me see here. So they're estimated to have a growth of 21% EPS, earnings per share, this year. The prediction, the estimates were raised from, like, let me see. It was $3.67 per share last year. This year it's set to be like $4.44. So definitely growth. And, with the market being how it's been, it's hard to find companies that are actually growing or estimated to grow this year. Because a lot of them are obviously losing, right? So Big Lots has been growing, and they even have a dividend of 3.29%. So that's really helpful too. So let's see. And the price target. Now one thing I want to mention, I am a huge fan of Zacks. Zacks is, they have a lot of financial articles. You probably have heard of them. I'm a huge fan of their ranking system, of their recommendations, pretty much everything. They have a price target on Big Lots of $42. And right now, as I said, it's just under $35. So for me, that's price, that's room to move upward. My concern is always when I'm looking at these sorts of stocks, like, it's gained so much. Is it too overbought? Is it too high? Has it gained too quickly? The RSI is a really good way of looking at that. The RSI is the relative strength index. And I'm kind of trying to define these things as I go, just in case people don't know what they are. I know a lot of people will know what they are, so I'm sorry for that. But
this
trying
is
to...
more for my sake.
Yeah,
and
well,
the people that are beginners.
Anyone else, I mean...
Yeah, they're beginners, right?
But the relative strength index kind of shows how strong the movement of the stock is. And if it's too high, it's kind of overbought, right? If it's too low, it's oversold. So anything over 70 is overbought. Anything under 30 is oversold. Generally speaking, I mean, it just depends on the stock, right? But this still has an RSI of 66, so it's approaching overbought territory, but I think it still has a good bit of room. Let me see how it's doing today, whether it's up or down, because I thought I saw it go down today a little bit. So, yeah, it didn't work. So there we go. Yeah, it's actually down. Oh my god, 4.4% today. To me, that's actually good. It means there's a pullback. I didn't see any news that would cause this. It's probably just because it's been running up so much, just a bit of profit taking. I didn't see any news that would cause this. For me, that's a good thing. It means that, like, when a stock is running up and up and up and up and up, it can't continue like that forever, right? I kind of see it as sort of a pendulum. When it goes too far in one direction, it has to kind of come back to the middle. Yeah. So I'm kind of, having a pullback. I don't like buying a stock when it's up like 3% for the day or 2% for, I get a little nervous doing that. I don't want to chase a stock, right? So today seems that I'm going to buy it later today, having a pullback of 4.4% and still, in my opinion, having, all the same reasons to buy it. So that's why I'm buying it. So that's my pick for this week. And then my earnings pick, let's see what we have. All right, so earnings are always difficult. Oh, so just to summarize, so Big Lots, like I said, the ticker is BIG. Right now it's around $35. That's my pick for this week. But my earnings pick is a company called Lennar. I've never heard of this company before, but they're home builders. They build houses.
Oh, cool.
Yeah, I actually found a YouTube video from them. They sound pretty cool. Huh. And they have earnings before the market opens next Tuesday, the 16th. That's 16th, right? Tuesday? Yeah, we're going to say it is.
Today's what?
Today's the 8th.
Oh, the 8th. Oops.
Yeah. You're a little behind.
No. Yeah, it would be the 16th.
Yeah, so they're having earnings next week. Now, I was going to pick one this week, and there are a couple that are happening this week that I really like. The problem is that they've already gained like 20% in the last week or two. And for me, I'm not like just like I said, I'm not going to get into a stock that's already jumped 20% in the last week. It could keep going up, but it could also have everything priced in and not go anywhere or even drop.
Yeah.
Like when something's gone up 20%, it's just not something I really want to get into too much. So the one I was looking at this week was it's a company called Guess, GES is the ticker, and they're expected to beat earnings, but they've jumped like so much in the last 2 weeks, probably 20% or so. I'm not getting into that. So I'm looking at Lennar. The ticker symbol is LEN, and that is again a home builder company, and so they are expected to have earnings of $1.29 per share. Now Zacks has a cool thing. They have this thing called ESP, which is earnings surprise prediction, and they take a stock's estimated earnings, like what analysts are predicting, and they kind of look at how analysts are upping their estimates, in the time going up to the earnings call, and they kind of come up with, they call it most accurate estimate. So their most accurate estimate is $1.38. So if that's true, they're predicting a beat of almost 7%, 6.98%. So that's really positive. And Lennar has a history of beating on earnings. Like last quarter, they beat by 63%, basically, almost 64%. So they have a history of beating earnings. So I like what I'm seeing with them. And today, they're not really moving all that much. That was this morning. A lot can change in a couple hours. Let me see where they are. So they're at 64.22, and they're just up like 51 cents. So under a percent gain, which they've been gaining too, but just not as much. Like when I was looking at my other possibilities for earnings, their RSIs were like super high. Like Guess had an RSI of 72, 73. The other one I was looking at had an RSI of like 78, I think. I don't remember now. This has, let me see what the most recent is. I think it's like 61 or so. Let me look. Yeah, like 65 RSI. So again, approaching overbought, but not quite. That's pretty comfortable for me, right? So for me, and I like to, have an earnings play that's about a week out, because usually, sometimes the same week is fine, but usually if they're going to run up, it's going to be the week or two preceding earnings, right? And then after earnings, if it goes well. But just look at, like I said, Guess, GES has run up, like I said, and their earnings are tomorrow, or I think Wednesday, the 10th. So they've already run up, and I'm not going to get into that. So I like to be about a week out or so with earnings. That's why I'm not picking something this week. So that's my pick for earnings is Lennar, LEN, and we'll just have to see how they go. Their earnings are next Tuesday, the 16th, before the market opens. So that is it for our stock picks. And now, actually, Christine's probably like, yay.
I don't care.
Now we'll actually get into our topic. All right, so, we've gone quite a while.
Yeah,
sorry about that.
No kidding.
I'm sorry.
And I didn't know how to be like, okay.
Well, I had to talk about it. This will be quick, though. So our topic for this week is stocks or options. Stocks versus options, whatever.
We know the answer is options. Okay, bye. Just kidding. I couldn't resist.
So, and again, if you are listening live, go ahead and chat if you want to. Feel free to ask questions, anytime. So, we're talking about options, or stocks and options. I got into options a lot later than I got into stocks, obviously. I was talking about that a little bit yesterday in episode 0. I got into stocks, I don't know, roughly 9 years ago or so, and then options a lot later on. But, they both play a part. So I'm just going to describe a little bit. I do have a post about what options are, but I'm just going to talk about it a little bit just in case people don't know or haven't read that post or just kind of want a basic definition of it. So options, you know what stocks are, right? I mean, you wouldn't be here otherwise. But options they're called a derivative product, which means that they are based off of the price of a given stock, right? So you might have an option for, Apple or Microsoft or even the S&P 500. You can have options on, but it's a derivative product because you're betting on whether that stock's going to go up or down within a certain time frame, right? So an option gives you leverage over 100 shares of that stock, right? That's just kind of how it works. It's always, okay, not always, but almost always 100 shares per contract of options. And so, a lot of people think that options are really risky because a lot of people get into them without really knowing what they are or what the risks are, things like that, and then they get their account blown up. They get into a margin call where they don't have enough cash for everything they have going on, and it just doesn't end well. So that can happen. I was talking about risk yesterday again, and this is definitely riskier than stocks, but personally, I don't think they have to be all that risky.
Well, to me, it seems like you could just buy one stock and it barely does anything.
Right.
But if you have 100 shares...
Exactly. And the cool thing about options, let's say, Apple around like $320. If you want to buy 100 shares of Apple, I mean, you're going to be paying a lot of money, right? I mean, 320 is... You'd be paying like $32,000. I know I should have done that in my head, but my brain wasn't working. $32,000 for 100 shares of Apple, whereas buying a call option, assuming you think Apple's going to go up, a call option means that it's basically betting on a stock going up. Mm-hmm. Is only going to cost you maybe a few $100s. Just depends on the expiration and the strike price and that kind of stuff. I'm not going to get into all the details. I will go more into those details maybe in future podcasts, but not today. But all you need to know is that options give you leverage over 100 shares of a stock for a much, 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 much cheaper price. Again, with Apple, if you buy a call option, you might be looking at only a couple $100 premium versus buying the stock outright at like $32,000, right, for 100 shares. Which is really helpful. I mean, I like that, especially if you have a smaller account. I mean, that's when it's kind of riskiest is with smaller accounts. But it's also helpful because you can see a lot greater gains if you're correct about the movement of the stock, right? And the great thing about options is that there are option strategies pretty much no matter what you think is going to happen. Like, for example, I said with the market, I'm long-term bearish, but short-term kind of who the heck knows. And that's okay. And, with options, you can benefit from that. Let's say I'm neutral in the short term to slightly bullish maybe. You can benefit from that. Not by buying a call option, but you can do something called, an iron condor, or if you have the capital for it, a short straddle, strangle. And it doesn't matter, what these mean or not right now. What's important is that there are strategies for options no matter what you think is going to happen. You can even do a put credit spread, which means I don't think the stock's going to go down very much from here, and it's either going to stay the same or go higher. And by selling a put credit spread, then I'm going to benefit from that prediction, right? And there are so many different things you can do with options, right? And now with options, you can be either a buyer or a seller of options. 99, maybe a little bit less, 95% of the time, I'm a seller of options because it has a higher rate of success, a higher probability of profit than buying options. But periodically, if I'm really confident that I know where a stock's going to go, I will buy an option. And there's a lot of detail that goes into that. But basically, when you sell options, you don't have to be exactly 100% right. You just have to be I guess you could say mostly right. Okay, like let's say you sell a put credit spread or you sell a naked put, and you think the stock's going to go up or stay the same. Even if it goes down a bit, it's okay, because as long as it doesn't go down too much, you're going to be okay, right? And you'll receive that profit. Whereas with buying options, you kind of have to be right about the direction. Okay. The other cool thing you can do with options, there's something called LEAPS. It's an acronym, Long-Term Equity Anticipation Securities. So LEAPS are options that are more than a year out in expiration. So, into 2021, 2022, you have these really far out options. The farther out an option is, the more it acts like a stock. Just from a technical standpoint, the gamma, which is one of the Greeks, the gamma of that option is a lot lower when it's farther out. It's less volatile. There are still definitely risks, but it acts a lot more like the underlying stock. And it's still cheaper. It's more expensive than maybe shorter term, a lot more expensive, but it's still cheaper than outright buying 100 shares of that stock or shorting 100 shares of that stock, as it may be. So, LEAPS, that's not really something I've done too much, just because I'm more of a short-term trader. But, just to show, like with options, there's so much you can do with them that you just can't do with stocks. Stocks, you kind of have to pick a direction, say, okay, I think it's going to go up, so I'm going to buy the stock. I think it's going to go down, so I'm going to short the stock. Those are your two choices, right? With options, you can kind of be like, okay, I think it's going to go way up. I think it's going to kind of go way down. I think it's going to stay about the same and go sideways. I think it's going to trade inside of a range for a while. There's just so many possibilities with options that you don't get with just stocks, right? Now, I don't have all options. I do have some stocks in my portfolio. A lot fewer than I do options, but stocks, like I have some stocks that moved, 20-30% in the last 2 weeks. And, that's really cool when that happens. But it's just harder to predict where individual stocks are going to go, right? And you tend to profit less overall when it does make that move. Whereas with options, it takes less capital to profit as much as you can, and you tend to profit more. Depends on the strategy. There's some strategies where your profit is less, but your overall risk is also less. You're not going to lose as much. So it just depends on, what your risk profile is, what you're willing to put in capital-wise, what you're willing to risk, all that kind of stuff. But for me, options are almost always better than just having stocks. Now, when would I invest in stocks? Because I wouldn't always just do options. If I really, really, really believe in a company, and I actually want to own their stock long term, then I would do that. Now, I don't really have any like that right now, just because, again, I think things are so overpriced right now. I'm very short term. I'm very day by day. Let's just kind of see what happens. Right. But if there's a company that I really believe in, that I think it's going to go up long term over the next few years or even the next year, then I want to own their stock. Because if I own their stock, it's a portion of that company. Whereas options, you never have to even trade a stock of that company ever.
Oh, you don't, even if you have 100 shares?
Because it's leverage over 100 shares, but you don't actually have to own those 100 shares.
Okay.
If you exercise the option, then you can purchase those shares, but you don't have to.
That's interesting. I didn't realize that.
Yeah, so an option, you don't ever have to touch that stock. It's just sort of betting, I think it's going to go up, I think it's going to go down.
Oh, okay.
Yeah, but if I really believe in a company, then I want to own their stock.
Right.
And also, stocks return dividends. Options do not return dividends, obviously. And dividends, there are a lot of people who kind of center their whole investment strategy around dividends. That's not me. I like some dividends, but So, you get dividends with stocks. It's just sort of, if you're interested in something long term, it's helpful to have stocks. And if you want to collect those dividends. Whereas if you just kind of want to have a more short-term play on a stock where, I think it's really going to go up and I want to profit as much as possible from that, or, I don't think it's going to go down past a certain point, I can sell options, whatever. I mean, there's a lot you can do with that, as I said.
Right.
And, I mean, there's a lot of other stuff you can do with options that I haven't even discussed here, but that's kind of where I separate them. Depends on if I'm more short term, where I just want to bet on the direction of a stock, or if I actually want to invest in the company. That's where I am. The other case where I think stocks are better sometimes is when an option is either too volatile, where its its volatility is really high, or where its bid-ask spread is too wide. So you can have some options that don't have a lot of liquidity, which means it's not being traded a lot, and so its bid-ask spread might be really far apart. Right?
What is that?
So the bid and ask is like, the bid is how much people are willing to buy it for, and the ask. Wait, I'm going to want this up. I don't want to get this wrong. Yeah, the bid is how much people are willing to buy it for, and the ask is how much people are willing to sell it for.
Okay.
And so usually with some options you have a few pennies wide between the bid and the ask. With some less liquid options, it might be 5, 10, 15 cents wide. Some of them I've seen over $1 wide. You don't want that. It's just really hard to trade those, right? So for example, I recommended big lots. I would not trade options in big lots, because when I was looking at the spreads on those, it's way too wide. It's ridiculously wide, right? So that is not something, and I was looking pre-market, so it could have changed a little bit, but it just didn't look like it had a lot of flexibility there. So that's not something I would do options for. So if there's a stock you want to trade and the options just don't have a lot of liquidity, then you don't want to try to trade options on that. You just want to do the stock, right? So that's back to, if you think it's going to go up, you buy the stock. If you think it's going to go down, you short the stock. That just depends. But those are kind of, the situations when I would actually use stocks over options. But most of the time, probably 90% of the time or so, I would do options, because there's just so much more flexibility there. I mean, no matter what you think is going to happen, even if you don't quite know what's going to happen, you can do options. And last thing, one final thing that's really nice about options is that you can base it on probabilities. You can base it on statistics. You can literally have an options trade that for a fact has a 70% chance of winning, right? Because the numbers are right there. A stock, you don't have that. It's at best 50-50. I mean, it might be a little bit higher or lower depending on what's going on with that company. But when you buy a stock, you hope it's going to go up and you try to, have as much in your favor as possible. But it's more or less 50-50, right? You just don't know. But with an option, you can have that probability. You can say, I want an options trade that has a 70% chance of success, of profit. And you can create that. Now, that doesn't mean you're guaranteed to win. Obviously, it's not 100%. That wouldn't exist. But you have a higher chance of winning than of losing, right? And of course, I mean, the higher chance you have of winning, the less profit you get, because, the lower the risk, the lower the profit. That's just how investing works. But that's one nice thing about options. You can target your profit probability chance, versus with stocks where you don't have that. So I really like that. Being a math person, it's just like, okay, I have a 70 to 80% chance that this is going to work out, and that's really nice having that. So I think that's about it. Like I said, I use options most of the time, about 90% of the time, 95% of the time. with stocks, if I'm really interested in that company, I really believe in them, I'll buy them. If I just can't find enough liquidity with an option, then I'll buy the stock or short it. And that's about it for stocks. There aren't too many cases where I would buy individual stocks. So hopefully that makes sense. I know if you're not really into options, a lot of the terms will not have made sense, and that's okay. I will define those more later in future episodes. We'll get a lot more into options because that's most of what I do, so we'll definitely be getting into those a lot more. But I just want to kind of give you why would you do stocks or over options or options over stocks, and that for me is why it is. And they don't have to be, like I said, that much riskier than a stock would be. An option is definitely riskier, but you can have risk management, which is really important. We will cover that in the future. You should have a very specific risk management.
Strategies?
Strategy, yes. I couldn't think of that word. Thank you.
Really?
It was just escaping me. But you should have a risk management strategy that you define from the beginning, and you should follow it to the letter. But, it doesn't have to be that much riskier. So we will cover all that in the future. But that, in short, not so short, is why I would generally do options over stocks. So, let's see. That is about it for me. I hope that made sense to everyone, and I hope that helps. So, we will be here again on Friday for the next episode of Possible Promise, or the Possible Promise podcast. If you want to ask a question in the meantime, you can go to possiblepromise.com/ask and submit your question there, and we'll try to answer questions on Friday. So with that, I hope everyone has a wonderful week, and thanks for listening.
Thank you.
Bye.
Bye.